Greetings and welcome to the first episode of my podcast, Cash Talk with Scott, where I impart information, advice, and guidance on all topics dealing with your financial wellness. I've decided to use the podcasting platform to get my financial wellness program out. It's a great way to get the information out to the masses. Today's topic is bonds. I know. Not the most fun or exciting topic, and certainly not the most glamorous investment option out there. But bonds are very important. They are a foundation to the global economy and as an investment vehicle. Now, in my podcast, just as when I meet you in person, I'm going to provide a little bit more information, drill a little bit deeper. Not going to get boring. I'm going to arm you for the summer barbecue season, give you all the information to have people leaning into your conversations. I'm going to start with my graph. I love this graph. This graph shows the growth of $10,000 since 1980 invested in the three basic investment types. The bottom line there is cash or money market or a savings account. The next line up are bonds, what we're going to talk about today. And the top line are stocks. The two things that stand out in this graph, why I love it, are first, the performance of each of the three. So you can see the cash over that time frame turned $10,000 into a little over $63,000. Bonds turned the $10,000 into over $167,000, and stocks turned $10,000 into over $1.9 million. So we can see the performance of the three basic investment types, which is important, but we can also see the path each of the three took to get to the final return. And you can see that the cash is a smooth line. That is a savings account. You don't ever see your savings account go way down in value or way up in value. It's basically the same plus a little bit of interest. So it's a smooth line. Next up, bonds that we're going to talk about today, not as smooth, got some jagged bumps in there because bonds have a little bit of volatility to them. And then when we talk about investments, volatility refers to the up and down performance. So volatile investments like the top line stocks have higher highs and lower lows. Bonds fall right in the middle, both in terms of performance and volatility. You can see that the bond line is more jagged than the money market or cash line, but not nearly the jagged line of stocks. A bond is a loan. And as such, loans are very important. They're used to fund everything in the global economy. Businesses, everything from a couple of kids running a lemonade stand, they got to hit up mom and dad for the money for the lemonade and the cups. So they need a loan to get their business rolling. Businesses of all sizes, up to the size of Microsoft. Microsoft needs money to fund operations and expand their product line. Governments, the primary source of their revenue is borrowing. The US federal government is over $39 trillion in debt. So they've clearly mastered the art of borrowing. Even the mafia uses loans to fund operations. You know, loan sharking, where they take questionable individuals in dire situations with no credit background, give them loans at very high interest rates. All of those are loans, and all of those loans fund operations for those organizations. As an investment vehicle, loans are also important because people use loans to generate an income or generate revenue off their investment. As a loan, they are a more conservative investment option. The components of the bond. So first we have the face value. That's the amount that the bond is issued for. So that's the amount of the loan. Most bonds have a face value of $1,000. So most bonds are sold in $1,000 increments. Next component is the coupon or interest rate on the bond. So that's what the issuer pays as an expense to the investor, and that's the investment gain for the investor, the interest they're going to make on the loan. The maturity date is an important component because all bonds have a term, anywhere from as short as a few days to as long as 30 years and everything in between. Price, Now, this is not stated on the bond, but the price of the bond, it's issued at $1,000, but the price of the bond will fluctuate every day the market's open. We'll discuss that in a moment. Another important component of bonds is yield. It's actually one of the most important components because that's the actual interest paid to the investor over the life of the bond. Okay, let's get into it. How do you make money with bonds? So, first off, we have the coupon or interest rate. So, for the issuer of the bond, that's their expense. They have to spend that money to attract the loan. Who's going to lend anybody money if there's no interest involved? So, to the issuer, that's an expense. To the investor, that's the investment gain. Now, the coupon rate across the board is basically based on the security of the issuer. So the most secure issuers have the lower coupon or interest rates. The less secure or the higher risk issuers have the higher coupon rates. So let's start with the federal government. I mentioned before they have mastered the art of borrowing. They certainly have. There are many types of federal loans or bonds. We have treasuries, T-bills, T-notes, treasury bonds, strips, tips, and savings bonds. So the federal government has the ability to stand behind their bonds or loans with the pledge that they back their loans with the full faith and credit of the federal government. Now, that is a less secure statement than it once was, but the federal government can still print money, raise taxes, charge fees. So they can pay off their debt, their loans, no matter, because they have the ability to raise the funds no matter. So their interest rates, the interest rates that you get or the coupon rates that you get on a bond from the federal government are going to be the lowest because they are the most secure. You know you'll get your money back. States also issue bonds. They issue what are called munis or general obligation or revenue bonds. And those are bonds used to raise capital for certain projects or operations. States can't print money, but they can raise taxes and charge fees. So they are a pretty good bet to paying off their loans. Then we move into the corporate sector. Now, corporations, they can't promise, like the federal government, that they'll be around forever. There are many large corporations that were once huge, very popular, drove in a lot of revenue that are now gone. Think of Kodak or Enron or Blockbuster Video. Everybody used to go to Blockbuster at least once, twice a week. Now they're gone completely. So corporations don't have the same security as the government, so they're going to offer a higher coupon rate. Now, within the corporate sector, there's levels of risk. We start off with the most secure corporations. They're referred to as blue chip companies. Think of like Microsoft, IBM, have been around for a long time, will be around for the foreseeable future for sure. So they, can't promise, but they're going to be around for a long time. So those are what we call blue chip companies. So their coupon rates are going to be higher than government debt, but within the corporate sector, on the lower end of the corporate sector, as we move from businesses that have been around for a long time to businesses that have just started up, newer businesses, well, you know the stats on new businesses. I think it's 1 in 5 new businesses fail in the first 5 years of operation. Well, new businesses then have a lot of risk. If you're going to loan a new business money, there's much more risk associated with that. So their coupon rates are going to be higher. Let me illustrate this whole risk return dynamic. Say, for example, you got two cousins. Each cousin wants to borrow 2,500 bucks. Cousin A borrowed 2,500 bucks from you in the past and paid it right back. Cousin A also has a regular full-time job, have had the same job for the last 3 years, and is going to use the money to pop the question, go and get married. Cousin B also wants to borrow 2,500 bucks. Also borrowed 2,500 bucks in the past, but yeah, I don't think that fully paid off that loan. I'm pretty sure left you hanging on some of that loan. Uh, doesn't have a full-time job, has a part-time job. I'm pretty sure because it kind of moves from job to job. And going to use the money because all his buddies are heading out to Vegas for the weekend and he wants to tag along. So you got two loans, 2,500 bucks, both to family members, but completely different risk dynamics. Cousin A, that's a pretty good loan. Cousin B, that's a pretty risky loan. So you would, as an investor, want to make more money on the loan to cousin B because you're taking more risk. So the higher the risk of the issuer paying back the loan, the higher the coupon rate on the bonds. So talk about bond prices. I mentioned at the top, talking about bond components, that price obviously is a component. I mentioned that price changes constantly throughout the market day, and it does. So bond prices, the price that a bond will sell for in the aftermarket, is going to change and fluctuate daily as the markets open. Why is that? Simply, here's an example. Let's say you bought a bond a few years ago, $1,000 bond, and the coupon rate 5% on that bond. So you've had that bond for several years now, making your 5%. You're all happy, everything's honky dory. Today, though, you're looking on the internet and you see that new bonds being issued are being issued with a coupon rate of 8%. Oh, well, 8% is more than 5%. I'd sure rather make 8% than 5%. So, in order to do that, though, I don't have a lot of money. I'm going to have to sell my 5% bond, take the proceeds, and buy a new 8% bond. Well, let's think about this for a second. How are you going to sell a bond with a 5% coupon rate in an environment where new bonds are paying 8? Simple. You're going to discount the price of your bond to account for the lower interest rate. And there are actually very easy formulas you use to calculate this. So you're going to take your 5% bond and discount the price. Remember, it has a face value of $1,000. So you're going to discount the price, maybe say, for example, $800. So you sell your $1,000 bond with a 5% coupon rate for 800 bucks, because the bond is still going to mature for the $1,000. So somebody's going to make 200 bucks on the purchase there. So that's how bond prices change as interest rate changes. So as interest rates rise, bond prices are going to drop. Conversely, though, if interest rates drop, bond prices are going to go up. Using that same example, you have your 5% bond you bought a few years ago. Well, today you look and it's not 8%, but new bonds are being issued with a coupon rate of 3%. Well, holy cow, now your 5% bond has value. It's paying way more than current bonds. So you could sell your 5% bond for more than $1,000 to make up for the fact that your bond is paying more than current bonds pay. So that's the whole relationship between bond prices and interest rates. Yields, which are the gain from the bond, that's the interest paid over the life of the bond to the investor. Yields change, and they have that same sort of inverse relationship that price and interest rates in bonds have. So as bond prices go up, yields come down, and vice versa. As bond prices go down, yields go up. So let's talk about the Federal Reserve for a moment. That's, if you will, that's the bank, the federal bank for all banks. That's where all banks go to get their money for their operations. The Federal Reserve has what's called an overnight or a base rate interest rate that they charge to the banks to loan them money for their operations. This federal base or overnight rate is the base rate for all interest rates in the United States. So all loan interest rates start there, and all investment bond rates start there. So when the Fed lowers the base rate, that means the interest rate on loans are going to come down. But unfortunately, it means that the return on bonds are also going to drop. Conversely, if the Fed raises rates, that means loans are going to cost more, but bonds are going to return at a higher level. The media loves to only focus on the loan interest rates and never talks about the investment rate of return. So with the Federal Reserve and these interest rates and the Federal Reserve setting interest rates, we're at a kind of a unique period in time. You might recall back in 2008, we had what was called the global financial services meltdown. We had financial services banks, if you will, insurance companies all over the planet on the verge of bankruptcy. And the Federal Reserve here in the United States and their counterparts all over the planet, Federal Reserve banks all over the world at different countries, they all had to take extraordinary steps to avoid bankruptcy. One of the extraordinary steps they took was to lower this base interest rate to almost zero. And they did that a long time ago in 2008, and they held the base interest rate at a very low rate for a long time, for a number of years, almost until recently. So that the positives of all of those base rates being held so low for so long, one of the positives was the 3% 30-year mortgage. People actually became enamored with that and felt like that was their right and privilege to get a loan for 30 years and pay only 3% interest. Actually, I think if you actually did the math, you'd find out that it's very difficult for a financial institution to loan out money for 30 years and make any kind of profit at all, charging only a 3% interest rate. But that's where rates were. People became very accustomed to the 3% mortgage. Now that interest rates and the Fed all over the feds all over the world are letting rates rise now, and rising interest rates, um, to get things back to normal and for other economic reasons. But interest rates are starting to normalize. So the 3% 30-year mortgage is gone. I would never expect that to come back. The only reason it would come back is if we had another meltdown, and we certainly don't want that. So 3% mortgages were unusually historically very low. They were an anomaly, if you will. If you look long term at mortgage rates over the last 40 years, they're closer to 6, 7, 8%. Now, I understand home prices are 10x what they were. So the higher interest rates is a lot more money, but that's where interest rates are historically in the mortgage arena. Now, with interest rates coming back to normal on the loan side, they're also coming back to normal on the investment side. For the longest time, conservative investors haven't been able to invest in bonds because the return was so low. They needed to make more than that as a return on their investments. So for a long time, very conservative investors were investing basically in conservative stocks. And stocks, when you listen to my podcast on stocks, you'll find that they are more risky than bonds. So we are getting back to normal as far as interest rates go. So that's actually a very good thing. Paying a 6% rate on your mortgage, that's a little tight, but more importantly, making money on your bond investments, especially those of us who are getting close to and getting into retirement, bonds are super important. We don't want to take a lot of risk with our accounts, but we still want to make some money. We need to make some income. So interest rates getting back to normal is a very good thing. So we've been talking about individual bonds this whole time. Most of you, though, and most investors, period, invest in bonds through mutual funds and ETFs. They buy their bonds that way. They don't actually buy individual bonds. They invest through bond funds. Now, investing in a bond fund, even though the fund invests all your money in bonds, is not the same as investing in an individual bond. Why? Because the managers of bond funds are making money on the bonds based on the change of price. Bond funds rarely hold a bond to maturity, especially a longer term bond. They're trading bonds daily based on the price of those bonds. They're actually treating bonds like stocks, buying low, selling high. The difference is your profit. So bonds don't always respond, bond funds, I'm sorry, don't always respond to changing interest rates the way an actual bond does. So there's a little bit of a difference there between investing in bond funds and investing in a bond itself. There are risks associated with investing in bonds. I've mentioned throughout the podcast that investing in bonds is more conservative investment, and it is. But there are some risks associated with investing in bonds. But those risks really are mitigated by investing in a bond fund, because the manager of the bond fund are going to deal with those risks. One of the risks is interest rate risk. The risk that the interest rates you're being paid on your bond is not keeping pace with current interest rates. Well, the bond fund manager is going to take care of that. Inflation risk. That's the risk that your money is not keeping pace with inflation, that your rate of return is not equal to or greater than inflation. Well, the bond fund manager is going to handle that. One risk that still does exist is opportunity lost, the risk of losing the opportunity. So you remember at the beginning, I showed you a graph that showed you the performance of cash versus bonds versus stocks. And we saw how much stocks made, 1.9 million, which was significantly more than bonds. That means if you invested more of your money in bonds than is appropriate or good for you, and you invested too much in bonds, that extra you invested in bonds, you could have invested in stocks, and you potentially could have made a lot more money by investing in stocks. So you have to watch out for opportunity lost risk. And that just comes from investing too much in bonds. Give me a call. I can help you with that risk specifically. So why invest in bonds? Well, there are a number of reasons. The primary reason is diversification, spreading your investments out, not putting all of your eggs in one basket, if you will. There's a relationship basically between stocks and bonds. It doesn't exist as much today as it did 20 years ago, but it still exists. It's called negative correlation. That means they tend to move in opposition of one another. Let's take, for example, on a day when the stock market drops in value. Well, that's going to rattle stock investors. So they're going to get nervous. They might want to sell at least some of their stock to reduce the risk in their portfolio. Well, when they sell stock, that money goes into cash at a minimum. They might want to invest it in something very conservative like bonds, but the two are bonds. So when they sell stock, their money's going into bonds. And with that money going into bonds, that creates demand, more demand for bonds. That drives the price of bonds up. So stocks come down, bonds go up. Now, take the inverse. So stocks are doing well now. They're having a recovery day, or they're just going up in value a day, having a good day. Well, that's going to excite stock investors, and they're going to want to take money out of cash or conservative investments and invest it into stocks which are going up. So on a day when stocks are going up, taking money out of bonds is going to reduce demand, going to reduce the value of bonds. So bonds are going to go down in value. So we have this seesaw effect. So when stocks go up, bonds tend to go down. When stocks go down, bonds tend to go up. And it's almost impossible to predict when the seesaw is going to change. So cover your bases, invest in both. Another reason to invest in bonds is because bonds pay interest. And even in a bond fund where they're trading, still, bond funds are more conservative. They generate income. When you are in retirement and getting close to retirement, income is your number one goal. You don't care as much about the changing value in the stock market. You care more about the income it provides you, because bingo, your retirement account becomes your living income. So having investments that produce income aligns right with retirement. Well, I hope you enjoyed my first podcast, Cash Talk with Scott. More importantly, I hope you gained information that'll help you to better understand investing, because I'm here to help you. The purpose of my podcast is to help build your financial wellness. I have nothing to sell, just help and advice. Please reach out anytime with questions or for help with your personal situation. Also, if there are any financial wellness topics that are of interest to you, or issues that you or a family member are experiencing, please reach out and let me know. I'll put together an episode of Cash Talk with Scott to deal with it directly. Please click subscribe below so you'll be alerted when I post new podcasts. Thanks, and I look forward to chatting with you soon.